Pretty soon this part will be awkward. Like we will have the camera stuff done, but the conversation still is awkward.
It has to be.
It will be. So Joe Petty is with Guild Mortgage, and he's joining Alec and I today for Awkward Conversations in Real Estate. Thank you for joining us.
I'm awkwardly glad to be here. Yeah, no, it's great.
See, I pick the right people every single time. So I just wanted to talk to you.
The type of people you know. I think that's what it
Maybe
is.
it is.
Yeah.
My sphere. Yeah. Well, I met Joe because the lender I normally used retired.
Yeah.
And so he inherited me, whether he liked it or not.
Okay.
So now I know his cell phone number, and I'm like, I need help.
I like it. Yeah.
Yeah. So if I have a question,
I mean, the first thing you put in the email was, thank you for saying yes on such short notice. Exclamation point times 3. So,
all right. Tell us about why someone should talk to a lender. Why should we talk to a lender first, or when should we talk to a lender if you're thinking about buying a house?
Yeah. So I think that the best time to talk to a lender is probably when you're in I call it the thinking and planning stages. I believe the house is always the sexy thing. It's always the thing that people are going to look at first, including my wife and I. Before we decide if we're going to move, we always look at the house or the market, see what's out there to see if it's even appealing.
Okay.
Second to that, the financials are super important. I want to make sure that the home I'm looking at is actually something that I'm going to feel comfortable with financially.
Right.
Something that not only be approved for, but should I be approved for that? Should I spend that money? So it's never too early. I really think that as soon as you're thinking about purchasing or selling, if you need to purchase again, it's okay to talk to a lender and to kind of see what the temperature is of what you can get approved for and what you should get approved for. There's no obligation. There shouldn't be a cost in doing that other than some time. I think the fear of being judged or graded, I mean, how often do you really look at your credit report unless you're trying to apply for credit?
And they're worried it's going to affect their credit report if they go talk to you.
For sure.
That's the rumor. Oh, it'll hurt my credit if I talk to 4 lenders.
Yeah, absolutely.
How many people look at it on wherever they're looking at on their phone, internet, and then they get their actual credit score from the lender, and it's off.
Yeah.
So what's important to ask it from a reputable, what you're going to pull in order to qualify them for.
Yeah, for sure. I mean, and that's a great point, Alec. There's, I think, 57 different scoring models that exist right now.
Wow. I thought there was like 4.
There's a lot.
I know 457.
Well, there's different ones because there's different industries that are pulling your credit. When a mortgage company pulls your credit, you're probably going to see the lowest scores of whatever you've seen out there. And it's because it's probably the most in-depth credit analysis versus a self-reporting website that you can go to, Credit Karma, for example, or there's a bunch of them that you can see your own credit score. Well, that's all free. And the reason that they are in the business is for advertisers or via advertisers. So they're looking for people to come to that website so they can sell advertising. If I believe my credit score, I don't know, is on the edge, but maybe it's 650, and I go to Credit Karma and I pull it and it's actually 680 or 690, I'm probably going to go back because I'm kind of excited. That was better than I was expecting. If I go to the website like that and I pull my score and it's 600, I'm probably never going to check my score again because it's like devastating, head in the sand mode. So self-reporting is just a little bit fluffier on the scores. And actually the scales they use are completely different as well. And that's the same for car loans, credit cards. Well, everyone has their own scale.
Okay.
So 57 have been different from.
And I think most people think there's like Experian and like there's the big 4 credit.
Equifax, Union.
Yeah. Oh, yes. I don't know the names. That's your job. I stay in my lane, you stay in yours.
Deal.
Right?
I stand on the side of the road just like
You just like sign papers.
But going back to when someone should talk to a lender, the earlier the better. We don't have to pull out our credit pull. We can do a soft credit pull. We don't even have to pull credit, although I think we should. And nowadays most millennials and Gen Zers, which by the way, I'm a millennial and I'm 43 years old. So these age groups want to plan and feel confident about what they're doing. So I have a lot of clients, I'm sure you do too, that just signed a new 12-month lease, but they called you because after that lease is up in a year, they want to do something. So we can have that year to make some plans and really make sure they're in a really good financial situation. Tweaking their credit a little bit, opening an account or two or closing one so that in a year they have amazing credit with better pricing available for a mortgage. Or making sure that instead of this debt that they're trying to pay off, save some cash, they have assets in a year and have the choice of paying that debt off or having assets, because that might be a better tool to have in your toolbox to close.
So going to a lender ahead of time helps you plan for the purchase.
Absolutely.
Because what we think we might need to do is not always what we really need to do.
Yeah.
Okay.
Yeah.
And sometimes I always get mad when they're like, I just signed a 12-month lease. I'm like, why didn't we talk about this before you signed the lease? Because maybe you could have bought today. Because I think sometimes people don't realize there are programs out there. There's first-time home buyer programs. There's all kinds of, they might be read. I can't tell you how many times people, I'm like, just go talk to a lender. And they're like, he said I could buy.
Yeah. Yeah.
And I'm like, yeah, I just signed a 12-month lease.
Freddie Mac did a huge survey of first-time home buyers, or they're calling them future home buyers, a year and a half ago. And the results of that survey were very interesting. One of the things that they found is that almost half of future home buyers believe that you have to have a 20% down payment.
And
Still,
that's, yeah, you don't.
not at all.
No.
But that's a belief out there. So yeah, talking to a lender or a professional realtor at the very beginning of just you're thinking in planning stages. I don't have a goal yet. I'm just thinking about this and planning it. That's the best time.
And a good lender and a good realtor is good with you coming a year early and saying, I'm going to think about buying in a year or 2 years and helping you get ready.
Of course.
Like if they're pushing you to buy today, they're probably not who you need to be talking to.
Commission breath really stinks.
Yes, it does. Yeah, exactly.
Yeah.
All right. There's a lot of people seeing some low interest rates from builders versus buying in resale, and we had a little offline conversation about that. But people are focused on interest rates right now,
Yeah.
and so can a resale seller offer that also? And how does that work?
Yeah. So this is probably the number one topic of today is new home construction, low interest rates. How does current sellers take advantage of that same thing? I think we were talking about a national builder that was paying
9 points.
9 points to get the rate down.
And a point is 1/4%, or
The 1 point is 1% of the loan amount. So 9 points on a $100,000 loan is $9,000. $400,000 home, that's $36,000 just in points.
so our median price is 5 something, a little over 5.
Yeah, yeah. So,
Maybe. And new construction was even higher than that.
so let's say that builder that's offering 5%, they're paying on the inside of that loan that you don't see $42,000 to $46,000 in points for you to get that low rate. And they're doing that because they want to keep home prices where they're at. And right now appraisals are allowing that to happen because everyone's kind of doing that. Strategy for a home seller would be, I think, the exact same. That 4.99% interest rate is so powerful to the buyer compared to a $42,000 sales price reduction of a $550,000 priced home. And the sellers can do the exact same thing with a sales concession. A sales concession can go directly to that buyer's closing costs, and we can pay tons of points to get that rate down where it's comfortable for that buyer. And what it does is it opens up the buyer pool for that seller, because there are a lot of people that want to buy a $550,000 home. There's less people that are able and willing to do it. There's more people that would love to, but just can't quite get there financially. But if they're okay with paying full price and having seller pay for a big sales concession, we can totally get that rate down to the same 4.99. In fact, and interrupt me if I'm just blabbering.
We're on the edge of our seats.
Okay.
I'm curious. I think I'm learning a lot.
So
That's why I'm not talking.
a lot of
Well, you're also a big man.
clients are actually surprised when they find out that a lender can lock them at a rate all the way from probably 4.75, 4.625, up to 7.25, and every rate in between. The difference is how much is that rate going to cost them? And sometimes it doesn't make sense if that buyer is going to pay $42,000 that low rate. But if the seller will do it through the sales price, it'll absolutely make sense. A quick numbers calculation, something ran across my desk yesterday, and the client was looking at a $400,000 sales price, offering $390. It reduced the payment about $85 a month. If they offered full price at $400 and did a $10,000 sales concession, so not even close to what we're talking about with that 9 points, but a $10,000 sales concession on that $400,000 home, it reduced the payment over $200.
But it only costs the seller less money.
It cost the seller the exact same money in that situation if the buyer had come in with a $390,000 offer and they accepted it. For sure, a sales concession will impact the buyer more and cost the seller less for the same amount of gain for the buyer.
But people don't understand that.
Yeah.
And sellers get nervous.
Professional sellers, though, which are what the builders.
Right.
So they're either doing builder forward commitments where they're coming to Guild and we're blocking off $5 million of loans for the future for a certain amount of time, and they're paying that 9 points so we can advertise rates at 4.99. Or they're offering large sales concessions so that the buyer can do what they want with it, with their lender or whatever.
Okay, cool.
It's good to see a breakdown of that. What about the difference between a buy down and points? Benefits to either one? Which one's better? Because at least I'm not hearing as much of like a 2-1, 3-2-1 buy down anymore as we were 2.5 years ago.
Yeah, you're right. So buy down, I think what you're talking about is a temporary buy down.
Mm-hmm.
Yeah. So let's talk about what those are, right? A temporary buy down will substantially lower the interest rate, but for a year, 2 years, maybe 3 years. And then the rates will start going up to the normal lock.
And it doesn't get bigger the first year and then a little bit less the second and a little bit, and then it's like higher, but it graduates every year, right?
Absolutely. So a 2-1 buy down would be, let's lock your interest rate at 6%. But the first year, you're actually going to make payments based on a 4% interest rate. And the second year, your interest rate would be 5%. And then the third year, you'd be up at that 6% the actual lock. I believe that was really, really popular because when rates went from under 3% or 3% in February of 2022 to 4% in March, 5% in April, and then we're 6% in the summertime, there was a belief out there that this is temporary and we're going to go down just as fast as we came up. It's March of 2025 and we're at 6.5 average.
Yeah.
So rates have not come down as fast as we first thought they would. So I think the beauty of that temporary buy down is if you do believe that rates are elevated, but they're going down, you can have a lower interest rate, 4% maybe. And then when rates come down, you can refinance and you never have to actually pay your 6% payment. But that really hasn't happened. So now I think what's more popular is the permanent buy down because people are, understanding that, okay, the 3% is not ever coming back, but maybe 4% is not coming back. In fact, maybe it's going to be a long time before we get to 5s. Let's just get the best rate I can right now and be protected. And that's to be like a 30-year fixed mortgage with no prepayment penalty is the crown jewel of the world as far as housing goes.
Yeah.
No other country has it. Other countries do have mortgages. Some countries have fixed rate mortgages. But to my knowledge, no one has the fixed rate mortgage over 30 years with no prepayment penalty. And it's just like the socket wrench in my garage. If I get an interest rate that's locked for 30 years, I know that my housing payment is fixed. It's not going up. But if I get the opportunity to refinance, I can refinance and lower that payment, and my payments only go in one direction. That's down, just like that socket wrench. So paying points, getting a permanent rate buy down, if you think rates are probably going to maintain, is probably what most people are going to do versus the temporary buy down because we think rates are going to go to the high 4s or low 5s.
Which it took us 30 years to get there.
Yeah.
If you look at like the history of interest rates in the 80s, they were crazy high. And it took us 30 years to get to 3%. Like, they're not going to go back.
Yeah.
It took a lot of weird things going on.
And it's through pandemics and financial collapse that we get there.
Yeah.
It's not good.
No. I always chuckle when people are like, when are the prices of the houses going to go down? I'm like, let's think about what was going on in 08 when that all happened.
Yeah.
Like, nobody had a job. Everybody was uncertain. That's what happens with low prices, right? I mean, if we're seeing low house prices, there's something horrible going on in the economy.
In 2008, we had an oversupply of housing in our country, by far. We haven't had an oversupply of housing since then. I mean, do you guys remember there were counties in the United States that were considering bulldozing brand new subdivisions?
They did. I think there were some that were bulldozed. It was crazy.
I mean, it's mind-boggling.
Yes.
We haven't even been touching that place. If we built as much as we could right now, it would still take us 3 or 4 years just to match the demand for housing.
Yeah, we are actually really low in housing, like way many units behind.
Yeah.
We need a lot of houses. There's lots of buyers out there. And some of them can't buy because of interest rate and their income and the median price.
I don't think they can because they haven't talked to anybody yet.
Or they don't think
They're saving for their 20% down payment.
Yeah.
Me too.
And I think sometimes people don't realize that if you just move a little bit out of, you don't live in downtown Boise in a loft,
Yeah.
you know, live out in Canyon County, which there's really nice neighborhoods in Canyon County,
Like
nice houses. And Middleton,
You're moving out there soon, aren't you?
I'm not, but my son can when he comes back. But yes, no, I'm happy. I would move into downtown Boise with no yard, no garage,
Right.
nothing. No,
You're so close to all the restaurants. You can just walk too.
yes,
Your scooter.
my scooter.
Mhm.
I like to scooter.
Yeah.
It's fun.
So dating the rate is still a thing, or are we past that terminology?
Oh, yeah. Marry the house, date the
That
rate.
was 3 years ago.
I don't think people understood what that meant unless you were in the industry.
Yeah.
They're like, what are they talking about?
Very
But it
catchy.
is- It is catchy.
It's like I'm not going to date something and then marry something else. That's not right.
Well, some people do.
That's not right. Good timing.
Yeah.
Thank you. Sorry about that.
I mean, yeah. The problem is we just don't know what the future holds.
And they were talking no rate cuts like in December, January, and then I heard a whisper the other day that there might be a couple.
Yeah.
Have you heard that too?
Yeah, I think the futures markets on interest rate cuts from the Federal Reserve right now is 3 cuts. But that has wavered.
Yeah.
0 to 3 and back and forth.
I'm not betting any amount of money on that.
Well, save that money and then put a down payment on a house
Right.
for your kid. And
Exactly. My kid can live down. He can buy his own house. I sent him Girl Scout cookies.
What do you think the real estate market looks like in our area in the Treasure Valley for the foreseeable future?
Like busy. I think we're continually busy because we have a great place to live and work, and people want to live here.
Yeah.
So, and we don't have inventory, and there are buyers out there. Lots of them swirling around.
Yeah.
So I have listings, and they're constant
Mhm.
buyers, and there's people out there.
Yeah, so earlier today you had mentioned that you've seen a big uptick in your clients reaching out, ready to sell.
Yep.
I think that's kind of an important thing to talk about because it's different than what we've had for the last couple of years.
Yep. And I think it's partially that one of our economists said the pain point would get there, right? Interest rate they have 2.9 that they love and their low payment, and then they had an extra baby they didn't anticipate, or they got a divorce they didn't anticipate, or someone passed away, or they got remarried, or got job promotion, hurt a knee and can't go up the stairs. They're got grandkids and they want to move somewhere close to them. So there's all these reasons people move, and the pain point is gonna where they're okay leaving that 2.9% and going on to something else.
Yeah.
And seeing opportunity. And right now it's a good time to buy because it is in for most of the Ada County and Canyon County, it's a pretty balanced market. So you're able to ask for some concessions like you were talking about, and ask for repairs. It's not such a feeding frenzy that it's been.
And that is unique. Not
It
all
is.
markets allow you to have 9 points paid for by the seller to get the rate down.
Especially builder.
Yeah.
Right? Builders are the ones that are like, I always kind of watch what the builders are doing because they're very telling about what's going on in the market. And I think they did anticipate the rates going down.
Yeah.
Because they built inventory and then suddenly the rates didn't go down. So they're putting it down themselves
Yeah.
because they have a little bit more inventory.
What is a typical rate right now this week for conventional home?
I've seen 6.5. I mean,
Yeah.
I'm not.
So if somebody purchased tomorrow the 6.5, where's the recommended level of when they should think about refinancing? It's essentially just to refinance out of the rate to a new rate.
Yeah.
Not to cash out, whatever it is, just to get down to the rate that they're more comfortable with. What would you recommend seeing as a drop? Is it a full point before you start looking into doing that? And at what point, maybe a year or two into that loan, is it better or worse to do it further into it or quicker?
So this is a great question. A lot of people feel there's a rule of thumb that you should at least drop 1% interest rate. Those people are generally not in mortgage. Those are people that have heard something from their parents, but don't really know why. The real answer is it depends. It's a really interesting scenario. The bottom line, it needs to be worth it. I know right now a lot of my clients are calling me because they're getting mailers telling them they can lower their rate right now to 5.99. But the rate is only one side of the equation, just like we talked about with the points and the buy down. There's always a cost to that interest rate. And so if the real cost of that 5.99% interest rate is $15,000 or $20,000 in points, it's probably not going to make sense. At the same time, though, if I can lower one of my customers' interest rates by a half a point, and they have a $800,000 loan amount, but I can do it for relatively little costs, that might really pencil out pretty quickly and have the break-even point within a few months. If that home is their forever home, at least at that point, it might really be worthwhile to lower their rate by 0.5%. Another thing though is if the client has high school kids and they know for sure that they're going to follow them wherever they go to college in 2 years, it might not make sense to refinance at all because if they're only going to own the home for a couple of years. Something else that's kind of interesting on this whole refinance discussion is the fact that most people believe that the only option is a 30-year fixed mortgage or maybe a 15-year fixed mortgage. And it's more powerful to be able to dive in and actually know that you can do a 28-year mortgage if you want. With certain lenders, with Guild you can, or a 29-year mortgage or a 27.5-year mortgage. And the reason that's important is because on an interest rate, on a loan with an interest rate, the beginning few years of that mortgage is going to be almost all interest that the buyer is paying, not principal.
Right.
And so if I look at how much interest is paid over the first 2 years of my client's mortgage when I'm looking at refinancing them, it might be $30,000 or $40,000. And just by giving them a 28-year term to finish the loan where it started off at and not extending their loan by 2 years, we can save them that $30,000 or $40,000 in interest payments. And the offset of that would be, a shorter term loan, 28-year term versus different. So maybe the payment is $20 more per month instead of the maximum savings that could be of less than $20 per month. So that's another powerful tool when you're talking about refinancing. It doesn't have to be the exact same term that you started off with.
Are those available for purchase or is that just for refinance? Just year terms?
Purchase too. Yeah, in fact, so a lot of lenders would have the ability to do any loan from 7 years to 30 years, any month in between that.
Oh,
So 359-month loan, 322-month loan, whatever you want to do. At least we can, several others can too. Conventional. FHA and VA are a little bit more strict on the term.
It's always fun to talk to a lender who's really good at what they do because there's so many creative options out there that are, I call them creative, but they're not like under the table, weird like all the things that people think of with creative lenders, like scheming and scamming in the background. But there are creative ways, like different loan programs, different first-time home buyer programs. There's tons of like grant programs. There's all kinds of things out there for folks. So sometimes it's just so important, I think, to talk to a lender because there's so many things and it's like a shell game a little bit in a legitimate way.
Yeah, there's a lot of options out there.
Yeah.
And they have their pros and their cons, and it shouldn't be a mystery of what you're getting. And it's not all good, every single one of them. There's, with a 28-year term, the downside is your monthly payment's going to be a little bit more than if you did a 30-year term. So you got to weigh those differences.
One of the things I always tell my clients when we close is with a loan is that if they pay one full month a year, it'll lower their rate by about 7 years, right? Or lower their term. It's not exponential. I found out that if I double my payment every year, like if I make 2 payments extra every year, it doesn't give me 14 years off my loan.
Oh, yeah.
Right. There's math people understand that. This math person doesn't. But so can you talk about that with little tricks? Is there other little tricks besides that? And it doesn't matter when you pay the full month. You can pay 1 month extra when you get your taxes back. You can pay a little bit every month, right?
Yeah, that's right.
And then it will lower their term.
Yeah, so
organic way.
Yeah, you're totally right. If someone makes extra principal payments, and right now with rates around 6.5 on average, if someone made one full extra payment towards their principal only each year, that would reduce their total term 5 to 7 years, something like that. I heard that also being told to people back when rates were at under 3%, 2.5%, and it doesn't work the same because you're paying so little interest compared to 6.5.
Oh, yeah, okay.
But the concept is similar. The more money you pay now at the front end of the loan, the less time you'll end up paying. There's another tactic though that might be more powerful for folks, because very few people actually keep a 30-year fixed mortgage for the full 30 years because of life events that I talked about.
Yep.
So a lot of lenders will offer something called a recast. Have you heard of this? Okay.
Yeah, I was going to ask, and then I was like, maybe you don't want to talk about it.
Oh, I love this.
Okay.
A lot of my clients like this. And actually, this is a strategy right now that we're using because of the low inventory. I have a lot of clients who are a little bit nervous about putting their own home on the market, selling it, so they have those proceeds available for the down payment on the new house, because they simply don't know what's going to be on the market at the time their house sells.
Right.
And they don't want to be homeless, and they don't want to buy or move into a rental.
And they don't want to have to buy a house because they don't have a house. So
Totally.
not get perfect.
Yeah. So the recast allows you as the buyer to make a regular purchase, maybe with minimum down payment. And then after your home sells, you then take the proceeds from that sale and apply them to the new loan that you already received. And normally in that situation, you would just take off a lot of years at the end of the term. But with the recast, the lender will re-amortize the loan over the remaining term with the new lower principal balance and actually give you a brand new monthly payment for the rest of the term of the loan.
I've had a few people do that. It's amazing. It's so nice because they only have this really crazy high payment for a month or two until their house sells, and they recast it. Oh, okay. So this is another little secret I've just learned is that lenders, and I think this is grossly unfair, but if I buy a house today with you and use a loan product, and then Alec pretend he gets into the lending business and he woos me with some weird magical 2.9% interest rate, and the Ed McMahon person over there. And I decide to refinance my house like a month in or 2 months into my loan, that you actually lose your commission.
Yeah, that's interesting. It's called clawback.
And I just think the public should know that, because that's no other job have I ever heard that before. Here, you made this money. Oh, this person who I have no control over, who did something bad, took my money from me. Yeah,
it's really bizarre. I was already in lending for several years before I got my first one and understood what this was. And I was like, what? This happens? So thanks for bringing this up. When most lenders close a loan, most of the time, that loan is going to be sold to Fannie Mae or Freddie Mac. The servicing of the loan, who the buyer makes that mortgage payment to, doesn't have to go to Fannie Mae or Freddie Mac. It's usually like with Guild, it stays with Guild. Fannie Mae and Freddie Mac, though, won't make any money on that loan for probably about 4 years. That's when they'll break even from the cost of purchasing that loan from Guild Mortgage or another lender. So if that loan is paid off or paid down substantially, generally within the first 6 months, then Fannie Mae Freddie Mac have contractual obligations with the lenders they work with, Guild, and they say, if that happens, we're going to claw back all of the income that we gave you for that loan. Because there's really no income left for them to make. And then the mortgage company does the same thing with the loan officers that helped originate that loan. It varies a little bit. It's not always 6 months. If I have a client that needs a loan, but I know it's going to be a little bit temporary in nature, we just have this conversation. And although there's no hard prepayment penalty that a client's going to sign on a Fannie Mae 30-year fixed loan, if I know that client's only going to have that loan for a month, I can't originate it. It just, there's no benefit there. And so I'll help them watch. I can know the exact day that we're kind of released from that obligation with Fannie Mae or Freddie Mac, and they can pay the loan down or off. And it generally happens for us in about 120 days. But it is a real thing. And it doesn't happen right now so often. Back when rates were at 2.5, it happened. Because someone would refinance at 3.5, and then rates would come down, and now it's at 2.5, and then refinance again. So, yeah, pretty interesting.
That was, I think that was my most startling thing I ever learned in real estate, and most unfair.
Yeah.
Because you work hard. I mean, sometimes clients don't, just like our jobs, they don't see everything that you do. And sometimes you're massaging numbers and pulling things and researching loan programs and making phone calls to get things to happen.
Yeah.
It's a lot of extra work. Who I worked with before, she would call me at like 8 or 9 o'clock at night. I just found another loan program.
Yeah.
I'm like, why are you working right now? You
Yeah.
should be at home enjoying yourself. But that's what you do.
Well, I really appreciate that. It's simple. It's not easy, right?
Yeah.
But life does happen. I don't want any of my clients to keep themselves up at night because they really need to pay this loan off. His life changed. It's just part of the thing.
It is part of the game. Knowledge. If they can wait just a little bit.
Yeah. It's a courtesy. And I talked to them about that at the closing table.
Yeah.
They said, I'm going to pay this off as quickly as I can. I'm like, okay, just be careful because there's somebody sitting here that deserves every paycheck. You got to be blunt without being blunt, right? That's okay to have this conversation.
And that's why it's good to have a good closer that understands the program because you are an advocate for all parties.
And then you had all these people that were signing at 2.5 or 3 saying, I'm going to pay this off as quick as I can. I'm like, this is almost free money for you.
Yeah.
Put your money somewhere else.
Yeah.
I'm not a financial advisor, but put it somewhere else is going to yield more.
Yeah.
It's funny with vacant land and vacant home scams. So if you have a second home, the people that are doing the scams are looking for the most part for homes that don't have a loan. So I've been telling anyone, if you own a house free and clear, you should really be looking at putting a HELOC or something on the house because
File a deed of trust against it.
something
That's not going to require payoff when they close up the loan.
And they also say watch it. So put your house, like claim your house on Zillow or claim your house on Redfin or one of those websites that you can, and they'll send you an alert if somebody lists it. But people are stealing your home and you don't even know it.
Ada County has something now that you can put in a parcel number, however many you want, and any variation of your name, and it will alert you by email if anything records against your name or that property.
Wow, that's cool.
That is really cool.
Through the Ada County Recorder, at least the last time I checked, it was there. And it was the only county this time that does it, but you can go in there and add that on there. So if it records, it's something, because when they index it, it'll have a name on it, and it'll be tied to a legal description of a parcel number, and it'll, I haven't seen it in action.
Yeah.
It'll alert you by email if anything records against your property.
Super cool.
Crazy. There's all kinds of stuff. Did we have other questions we had to ask?
The last one is anything else? We kind of bounced around and went through a lot of them right at that point, yeah.
I have a question.
Okay.
I'd like to know both of your opinions because this is something that's never happened before.
Probably grow it out just so.
So there have been real estate companies that have purchased or built their own internal lending companies and title companies. But Rocket Mortgage just purchased or announced the purchase of Redfin.
Mm-hmm.
So it's the first time that I'm aware of a mortgage company purchasing
A real estate
office.
Yeah.
And so I would love to know what you guys think about that.
I don't know enough about it to make a comment yet.
Okay.
I need to research a little bit. I have heard that they did that.
Yeah.
And I don't know. I always think everything should be separate.
Yeah.
Right? And because the consumer I just think it protects the consumer, right? If they go to you to get their mortgage and they go to me to get their real estate and they go to somewhere else for the title, there's checks and balances. And while I would like to believe that nothing nefarious is ever happening, I've seen greed, right? And last year there were agents that didn't make any money. They didn't sell anything. There were lenders that didn't make any money.
Yeah.
Just be careful.
Yeah, it's definitely interesting.
Well, a lot of people see through that too. They're like, that's great. I'm using an agent that works for this broker that has their own. I don't need to use them. Is it going to benefit the realtor or the lender in this case more to use one and the same, but the consumer, the client, is not getting the benefit of that?
Well, sometimes they'll offer the consumer. So there's some builders that'll offer the consumer, if you use our lender, we'll give you the points.
Mm-hmm.
Or if you use our lender, we'll give you this weird cool upgrade or something. They're offering, and I always caution people, if they're dangling a carrot in front of you, what's on the other side of the carrot?
Mm-hmm.
Like, what's in it for me? Because nobody's doing. There are acts of generosity. I've had some today from another project I'm working on, but for the most part, most of us are like doing what we can to make our ends meet. Yeah.
It costs the same amount of money to make the widget, no matter who makes the widget, so you're paying for it somewhere. I'd rather know
Yeah.
where the money's going. But
Yeah. And I love working with a local person because I know you're spending money in Boise, right? Or Boise Valley. I also know that I might run into you in the grocery store. So if you do something underhanded, you're going to have to look at me, like see me at a kid's game or like we run into each other around town and we know people. And when you're a big national thing, it's less personal.
Yeah.
And real estate is very personal.
I 100% agree. It's so fun to run into your business partners or your clients in the grocery store.
Yeah.
Because, what we do is great for the community. It feels good to have someone buy the first home.
In that project I'm working on, it's really funny. I've had a couple of people I know from better clients donate money for this cause. And I've had real estate agents who are technically my competitors that are like, whatever you're doing, I'm going to be in on that.
Yeah.
And you're like, that's cool.
That's
Or
cool.
you wouldn't get that if it was national.
We really need to cheer each other on no matter what part of the industry we're in, right? Support each other, say good work, how can I help?
Yeah.
I don't know if I've mentioned this to you because I don't go out there and talk about it all the time, but I'm currently the president of the Idaho Mortgage Lenders Association, which is the Idaho chapter of the Mortgage Bankers Association, our industry trade group. And we just had our monthly board meeting last night, and we're talking about a proposal that we can try to have some grassroots help with that would alleviate a little bit of property tax for some homeowners for their first 3 years of homeownership so they could afford more or at least not be as tight monthly budget wise. And so when you're talking about advocating for our communities through partnerships of our industry, you're spot on. And it's important that we do these things.
And we have a group that does advocacy for that kind of thing too. So I was just thinking you need to call Idaho Realtors and talk to them because we have a legislative liaison. That's what his job is.
It's totally on the list. In fact, you're on the top of the list because we have that liaison.
Yeah, yes. But we do have for Idaho Realtors, and I think that's the other piece. We get a bad name as an industry. And if you saw property tax reductions on your taxes this year, we were at the State House advocating for that. Now, we may not be the only reason that you got that, but we are.
Thank you.
It's a voice,
It's
right?
a part of it, right?
It's a part of it.
Standing up for each other and helping clients.
Some of we hear weird things going on in the industry, like property rights that are getting taken away or not being used, and we're out there fighting for them.
That's great.
Yeah.
It's really,
Sounds wonderful.
yeah, the Idaho Realtors has a committee of about, I think there's 20 or 25 people from around the state. And during the legislative session, they meet every week and they read the bills and they look at them and they're like, we don't like this sentence, or they need to change this, or this, they did it like this. This is how it would affect somebody in Coeur d'Alene, or this is how it would affect somebody at Bear Lake. And so they're getting input from all over the state, able to help make it the best bill they can. They don't always get it through, but they are working for it. They have a lot of input.
It's super cool. Love hearing that.
Yeah, and if your real estate agent helps with that, they're helping you. They ask your agent if they invest in RPAC.
Okay.
Which is the Realtor Political Action Committee. And
Okay.
and you guys can do it too. There's a way to do it as a non-realtor,
Oh, okay.
as an industry partner.
That's cool. That's why we do that.
Yeah, it's very cool. It's one of my passions.
Do you want to hear one of my favorite stories
Yes.
about lending?
I don't really. Yes, I'm not going to say no.
So, several years ago, remember back when you could purchase a home and have your mortgage payment be about the same as what rent was back here? That first time home buyer reached out to me. She was very young, married, no kids yet, and no one in her or his family had owned a home. None of their friends really owned a home. They just happened to see some sort of a promotion and said, you know, next time we have to rent a house, we have to come up with our deposit, first month's rent, all these other things. This is saying I can move into a house that I own for less than that. Let's just see. So, got him approved with a home buyer for some home buyer financing with some document assistance. They moved into a brand new home. It was awesome. Their payment was less than rent. Moving into the home was less than rent. And they were happy. She came back about 4 years later and said, Joe, I have 2 kids now. I have a better job. My husband has a better job, but we're bursting at the seams of this house.
Right. Pain point.
What do we do? I said, oh, this is great. You're going to sell this house and you can buy a new house that's better or bigger, better deserved for your needs. And so I reconnected them with the agent that had referred them to me in the first place. She listed the home, got it under contract. They were in contract for a new purchase, again, a brand new home that was nicer, bigger, met their needs. But she had gained so much equity in the home that she purchased with almost no money down that we were putting a down payment on the new house, paying off all of her bad debt, credit cards, and other higher interest rate loans. And for the first time in her life, setting aside a portion of money that she could just keep in savings for emergencies and other things. And everything was going great. She came into my office unexpectedly with a bunch of papers in her hand. And she had this look of dread on her face. And she asked if she could meet with me. I said, of course. I said, what's going on? And I'm thinking, worst case scenario, like there's been an accident or something has happened. She said, I want to make sure we're not doing anything illegal. I said, what do you mean? She said, well, when I bought this house, I didn't put any money into it. And now you're saying I'm going to actually get money in my savings account. You're paying off this debt and now I'm putting money down on the new house, but it's not costing me anything. And I really don't understand what's happening. And I just don't want to do anything that's illegal. So I understood she doesn't have any people that she can go to that have talked to her about equity and building that. Right. So I explained the whole process to her just at a much lower level, like just basic level. And I know the moment that she understood because she started crying, she gave me this huge hug and she just told me how she did not know what she had done 4 years ago was going to be life changing, probably for her and her kids, but it has been. Mm-hmm. And she is totally good now. She has so much equity in her home. Owning that home has given those kids another steady foundation for school and other things. And she's a local person. So it's really cool to see people in our community being better than they would be without the homeownership.
I know. There was a lot of those folks I helped in 08 and 2010 that bought houses really low. And they were almost all of them were working entry-level jobs, very minimum pay, but they were able to put 2 or 3 family members together and buy a home. And they have $300,000 or $400,000 in equity. There's nothing in the world you can do to build that kind of equity when you're working at, a local gas station.
Yeah. And to protect it because rents have continued to go up. So even if you didn't buy a home, your living expenses have increased over that same period of time to the point where what do? You either keep looking for a less and less expensive to rent place.
And smaller and smaller.
Smaller. Yeah. Keep moving. Have more people live with you. Or you just say, what can I afford right now? Get into the market so that you're protected.
And I see you're drinking coffee, but you don't have it in a fancy cup from I think that's the thing people have to give up is my daughter spends my homeless trust fund baby, a lot of money on a particular coffee brand in town. And it's, and I should just buy a unit of it because like a franchise,
Yeah.
because I'm pretty sure I could pay for it before I pay for her coffee. It's ridiculous. And so if you just think about what you're spending, sometimes that mortgage payment's there.
Hard thing today is going to turn into a great thing tomorrow. So I remember in 03, this guy looked at me and said, "Should I buy a house?" I'm like, "I need one."
Yeah.
Should have, but I didn't. So take some advice from people that have been through it.
Just I would tell all young people, buy the biggest house that you can afford and be able to live there for 10 years.
Mhm.
Like that mindset. Like I need to pick a house that I can live in for 10 years, even if I got married and had a kid. Like, so don't buy, one bedroom or a studio, but buy the biggest house you can afford that you could live in for 10 years.
If I can imagine myself brushing my teeth in that sink every morning for 10 years, that could be the home for you.
Yeah.
There's never been a period of time where home prices have not recovered and actually been elevated.
I did someone asked me when I got asked by the media, when would house prices in Boise reach $1 million as the median price? I don't have a crystal ball. I can't answer that question. I don't know. So I went back and looked at since the MLS started in 2000, whatever, our data went back to early 2000s. On average, this is on average, even with the recession, and even with 2020, our appreciation in Boise was about 6.7%. So if you own the house, every year your house would have appreciated 6.7%. There's nothing else doing that.
So do you know how much the interest rate would have to drop for a $550,000 home to go down in price when they're appreciating at 6.6% year after year? I mean, you'd have to go down in rate probably almost a full point to make up for the difference in payment of that home appreciating by $65,000, $35,000 in 1 year.
And it's insane.
Yeah.
So buy a house, use a lender, and then we'll use a title person to help us get it all closed.
We're all hoping that Joe brushes his teeth in that same sink at night as well, not just in the morning.
There, Alec is keeping it real for us.
Can I ask you guys something controversial?
Okay, we might not answer, but we might.
What do you think about reverse mortgages?
I know you love them. I meant to ask you about them.
We need to call them home equity conversion mortgages, not reverse mortgages, right?
Yes,
Mm-hmm.
that's what FHA calls them.
Right. It's a little less.
Yeah, I was always a little bit suspect of them until I had lunch with you, and now I recommend them.
Awesome.
Nobody's taken me up on it, but I have referred people to you for them.
So just like my first time home buyer, who didn't really have any people modeling what buying a home looked like, so she didn't really know what it was all about. I kind of feel like the home equity conversion mortgages, which is what FHA calls them, most of them are FHA products, FHA insured. Slang is reverse mortgage. I kind of feel it's similar. A lot of people have heard about it, just like she had heard about owning a home. But most people are a little bit unfamiliar with what it actually is, what are the benefits, what are the costs, and they are an interesting option.
You had a good story with them too for how it helps somebody when you were talking to me.
Yeah.
Was it your in-laws?
Great memory. My mother-in-law.
You don't have to share if it's like too personal
No.
because
No.
you're on film. This is forever.
No,
I didn't record. I've been checking to make sure it's still recording.
my first client with reverse with my mother-in-law, and there's a whole bunch of different reasons why people would get them, but for her, it's something that 100% is going to allow her to stay in her home with a low fixed monthly income that she has. She's in great health. In fact, her mom is still alive and almost 100 years old. But she doesn't have a large monthly income to be able to support increasing property taxes and other things. So, long story short, for her, she has a reverse mortgage that she never has to make a monthly payment to. And we included her property taxes and homeowner's insurance in that. So the only thing she has to be responsible for is utilities, house maintenance, some things like that. And she has full ownership of her home. She has tons of equity even with that reverse mortgage. So she can sell her home if it no longer meets her needs, take the proceeds, buy another home, maybe with another reverse mortgage, never have to make a payment again. So we'd almost have to have a separate podcast for the reverse
We
mortgage.
would love to have you back for that.
Yeah, that'd be cool. That's great. Here's one thing I would say though, from the lender's perspective, and I don't know why this has happened, but this is how it is. You talk to a loan officer that does not do reverse mortgages, or you talk to a loan officer that only does reverse mortgages. And it shouldn't be that way. They're just another loan. So when I'm talking to someone that qualifies for a reverse mortgage and a 30-year fixed mortgage, I like to show them both options. Just like someone who served our military, I'm going to probably show them a 30-year fixed conventional loan and a VA fixed 30-year loan. And reverse mortgages don't have to be anything but that.
Just another product.
Just another product.
And make a choice for yourself.
Yeah.
Don't make choices for other people.
Always.
Yeah. Let them make their own choices. We're grown-ups. We were talking about that earlier.
Yeah.
We're grown-ups. We can do what we want.
Thank you.
Thank you for coming. We had so much fun. We could have you again. You were easy to talk to.
Okay.
We made it awkward.
I'm going to bring more awkwardness next time.
It's hard.
This is just me, actually.
Yeah.
Awkwardness is part of it.
Yeah. That's how we are. We have a weird dichotomy.
I didn't know what to expect. This was great.
Good.
It's just a fun conversation. And I'll do little shorts and clips and I'll tag you
That's fine.
in social media.
Yeah.
I want the industry to be better and I want the public to have more knowledge.
That's cool.
That's
Well, I mean, you're heavily involved in industry.
Yeah. So if I get business from it, it's like a bonus. But for me, mostly it's like, does the public understand how a loan works?
Yeah. To better the industry.
Bettering the industry.
Super cool. I mean, there's enough business for the local people if we just support each other.
I know. And if I would stop buying coffee for my daughter, I have plenty of money.
I've become pretty good. We don't have fancy coffee, but we have a little KitchenAid that grinds the beans before it goes to my drip coffee. I mean, I prefer my little home brew probably more than most coffee shops now.
Yeah, I have my little concoction for tea. Has my MCT oil in it, has collagen, stevia, black tea, like a little, So I just make my little concoction.
I'm doing the collagen too.
Yeah, it
I-
helps.
I like it.